Well, so another big day. Is it over? The worry about the subprime mortgages and the so-called credit crisis. Is the worst behind us?
Some on our Fox panel would hope so, some not. But here now to talk about it, Nicole Ridgway, senior editor of SmartMoney.com, Mike Norman of the Economic Contrarian Update, and Jim Pettakakis from U.S. News and World Report. Not, Jim, that anybody would hope that it isn't over, but some believe that this is just a tease and that we've seen a 500-point gain over the past 2 days because we haven't had some really new bad news. What do you think?
Well, it's not that we just haven't had new, really bad news. We've had some, positive news. I'll tell you, when all this started, I said I could only get too bearish. I have 525 reasons to be positive. That was a 525 basis points the Fed could theoretically cut to help both ease the housing crisis and ease the credit crisis. I mean, the pessimism just got completely out of control. I mean, I started reading stories about, forget about recession, a depression happening. That leads me to believe that the analysis of the credit crunch was completely wrong. Is it over? Are there still going to be problems? Are there still going to be write-downs? I'm pretty sure, but I think what we saw from the Fed, especially in comments today, that they recognize the problem and they're going to do what it takes to prevent it from spilling over to the rest of the economy, which, by the way, is actually holding up pretty well. I mean, those holiday sales over the weekend, very good. I mean, there is some reason for optimism. This just isn't some technical reaction.
All right. And this, Mike, on a day when Goldman Sachs says it's more likely that we're going to have a recession.
Yeah, I don't buy the recession theory. Look, if you look at the contribution from exports to GDP in the third quarter, it outweighed more than 2 to 1 the loss we had from housing. I will say this. I'm kind of sad today. I'm a little bit sad.
Why?
Okay. I think Peter Schiff was supposed to be on the program. He's probably not feeling well.
Guess what? Guess what? Because you're so sad.
And I feel for them. People think I don't like him. I do like him, and I'm a thoughtful person at heart, really. And I brought some of this, and maybe he's home.
It's Pepto-Bismol, Peter. He's holding up a
guess what? Just for you, Mike Norman, we've got Peter.
All right. Peter, I do care about you. I care about you.
I know Peter's going to say, I don't need that.
It's going to be a lot. I know you've been saying it's going to be a lot lower. It must be a tough day for you. But look, buddy, I'm here to help.
Mike, I guess they say money can't buy happiness, right? So I'll just be happy with all the money. And you can, but anyway, look, it's just getting started. The credit crunch is just beginning. It's nowhere near over. And what we're witnessing right now, this is the beginning of the end of consumer credit as we know it in the United States. By the end of next year, it's not just mortgages. Americans are not going to be able to borrow money to buy anything. It's going to be all this consumer credit, whether it's for automobiles, for education, for credit cards. The world is not going to lend us any more money. We're not going to be able to borrow money from the people in Europe or Asia. We can't pay it back.
Go ahead, Jim.
Peter, they just lent us money. I mean, my gosh, these sovereign wealth funds, they just put in $7.5 billion. I don't think they think, I mean, they're not tossing that money down the sewer.
No.
They think that...
I'm talking about consumer credit. They're going to use their dollars.
I understand that. Let me finish. But you just expanded it to all credit. You just expanded it to all credit.
No.
Everything's going in the tank.
No. Hold on. Let me finish. Businesses will be able to get credit. Foreigners will use their dollars to buy up our assets. But they're not going to lend money to people to buy houses, to buy television sets, to buy cars, to take vacations, to buy gasoline, or to buy Christmas presents.
Well, hold on a second. We haven't heard from one of our guests here, Nicole Ridgway. Great to see. Of course, Peter included houses into consumer credit, but if, in fact, you include mortgages in there, that's basically the end of our capitalist system if there's no credit.
No, it's the end of our phony system.
Peter, Nicole?
Yeah, I mean, if there's no credit being extended to consumers, obviously the auto market would be hit further, the housing market would be hit further. Seems a bit extreme what he's saying. I do think that banks are going to be a little more reluctant to just dole out credit to anyone. They'll be doing much closer background checks and that sort of thing. But, we're not going to see the cheap money being turned around that we saw before. But credit will be
Mike, why is the market up 300 points today?
The market is up 300 points because I think yesterday was a catalyst. You saw the infusion of cash into Citi from Abu Dhabi Investment Authority. In addition, Liz, as we've been saying, there's been a pervasive psychology, incredibly gloomy. Look, some data came out on Monday from the Fed through the third quarter. You talk about bank position, financial position, Peter. If you look at total charge-offs right now, they are running far below the level we saw in 2002 and about, extremely below where we saw it in the early 1990s. Also, delinquency is the same thing. No way, when you look at the actual data and the facts, and understandably and admittedly, Peter, the numbers will rise through the fourth quarter. I agree with you. But they're not going to come anywhere near the high levels we saw in 2002 and 1990. What does
Mike,
it mean? It means the banking system is fine, Peter.
No,
it's absolutely fine.
Mike, the banking system is not fine. In fact, if our banks had to mark all their securities to market, they'd all be insolvent right now. This is going to get a lot worse. You know, today's rally is probably the catalyst was you had the Fed governor coming out. Hold on. Let me finish. You had a Fed governor.
In between the sentence, take a swing,
let me make an important point before you make a joke. So basically what you have is a Fed governor coming out and saying that he was wrong. The economy is a lot worse than he thought. And rather than the markets looking at the fact that, hey, this guy just admitted he doesn't know what he's talking about, the market is celebrating the fact that we're going to get another shot of Fed heroin, another rate cut. And the rate cut is not going to help. It's not going to help the economy. It's not going to help the housing market. You know, it's not. This is bad for the dollar. It's bad for our economy. There's nothing good about the Fed trading more.
All right, hold on. Let's take one of those points. Jim Petrakakis, what about the fact the Fed is now owning up to the fact that perhaps the economy is bad enough so that we do need another rate cut? Is that good news?
Right. Well, I mean, it is good news because most
everybody else on Wall Street that the Fed sees our economy in worse shape than they thought.
Right. Right, because that is going to lead to action. Listen, I mean, I'm not apocalyptic about this economy at all, but I do think that the insurance of some further rate hikes is fine. I mean, the rest. I mean, if you remember, listen, right,
further rate cuts. Yeah.
Remember Halloween. Remember in Halloween when they came out with that statement, they cut 25 basis points and they gave that very balanced statement. I mean, that Halloween was a nightmare for investors because it did show that the Fed didn't fully grasp perhaps how weak the economy was. So now they're going to catch up. They'll start cutting. And I just don't see the apocalyptic scenario that some people are portraying. Incomes remain good. Unemployment remains low. You get some Fed rate cuts. That's also good for the market. People feel wealthier from the stock market wealth. That is not an apocalypse now scenario.
Nicole, hold on, Nicole. We've seen the market sometimes take bad news as good news and then bad news as bad news. Right now they're taking bad news, meaning that the Fed is sort of crying uncle and saying, look, things are bad, as good news, and that's why the market is higher. At least that seems to be a consensus here. What would turn that around to make the market take bad news as really bad news?
You know, I think that even with the consumer confidence numbers being at a 2-year low, for some reason I think that there's been such negative momentum leading up to this that people kind of look at anything, the rate hike or the rate cut, being something that would promote spending. Now, what could actually bring this market down again? Maybe more bad news out of the banks. Just a continuing feeling that this is just not going to go away.
If we're going to worry about one thing, if I could just quickly say this, actions like Schumer going after Countrywide,
Senator Schumer
going, things like this could put a pall. Really, the type of things that Peter's worried about, which is not going to come about in the economy as it is functioning right now. But if we get these draconian measures to say, hey, we're fixing the system, when in fact they're throwing a wrench into the works, that could be bad.
Peter?
Well, we don't need a policy mistake. We're already in trouble. See, the problem is we've been borrowing all this money from the savers around the world, and they're just figuring out that we can't pay it back. I mean, they've lent us too much money. Look at the example. They had an article about in the Wall Street Journal yesterday or on Monday. A woman who bought a house 20 years ago for $105,000 is having trouble making her mortgage payment. Her mortgage is now $625,000. She's borrowed $500,000 against her house in the last 7 years and spent every single penny of it.
Yeah, but
she can't pay that money back. This is insane. This is how we've run our economy. We've gone on a consumption binge with borrowed money.
Guys, we got to stop to bring in a little bit of news. American Eagle. Home sales numbers are falling, but that is really only part of the story.
The other part is that the National Association of Realtors says sales of existing homes, yes, they did fall 1.2% in October. They have been falling for 8 straight months. But take a look at this. The median price of a home sold last month fell 5.1%. That happens to be the biggest year-over-year drop ever. So the prices are just tanking.
And the question is, how low will they go? Let's put that one to our Fox panel. First up, Rob Stein of Astor Financial. Good to see you, Rob. What's your guesstimate of how low these prices will go?
I think it depends on what part of the country you're talking about. Clearly there's some more room on the downside. I wouldn't say that the bottom is near in the next month or two. But some of the parts of the country I think will weather it better than others. Here in the Midwest, I can't imagine we were near that 5% average, but maybe another 5%, 3%. And I think there's parts of the country that might go 8, 9, maybe even another 10%. But you have to remember the amazing appreciation we've had over the last 4, 5, 6 years. We were at all-time highs as recently as 18 months ago.
But the question, Rob, is at what point will the prices have come down so far that will really spur buying?
Yeah, I don't know if it's a price thing. I think people buy when they're confident about their job and their employment picture, when they feel comfortable with interest rates and the economy as a whole. I don't know that price is the only thing that's factoring into it right now. So you have declining prices which aren't really soaking up the excess supply that's out there, but the uncertainty that's in the economy when you hear about what's happening in the mortgage markets, when you see the stock market declining day after day, today notwithstanding, it makes you cautious about buying. And I think when those things stabilize, you'll get buying coming in.
Nicole Ridgway, the thing is the speculators are gone. You don't have speculators coming in. You used to have both people that really needed houses and a lot of speculators in too. Now we've cut out one of those groups. Hold on a second, Rod. Go ahead, Nicole.
Well, now we're seeing the speculators who maybe bought these properties as investment properties and wanted to rent them out. Some of them are foreclosing on those properties too, so they're getting squeezed as well. And I agree. I think there's going to be another 5 to 10% correction in home prices, depending on what areas. Obviously, like cities in Florida like Tampa and Miami are getting hit harder than places in the Midwest. So, and there is that psychological component of what people feel they can buy at this time.
Peter Schiff, I know that you live in Connecticut. What is your neighborhood? I'm talking the surrounding streets, which I'm sure it's a very nice neighborhood. What are you seeing? A lot of for sale signs, and is that enough to get people to start buying?
Well, I've only lived there for 8 or 9 months, and all the houses that were for sale when I got there are still for sale. There's probably 5 or 6 houses that are multi-million-dollar homes that have never even been lived in, that are empty and for sale. But, there's 2 key points. One is, you already have a record number of Americans who already own homes. So there's not a lot of buyers out there. There's a lot more people trying to sell homes and buy homes. But the more important question is not how low home prices will have to go for buyers to want to buy, but how low will they have to go before lenders are comfortable lending. That's the key. And what's going to happen over the next few years is lenders are going to start requiring 20% or more down payments. They're going to require honest appraisals. They're going to require fully amortized mortgages. And based on how little savings the average American has and what our income is, prices are going to have to collapse before they're low enough for anybody to want to lend anybody money to buy.
But Mike Norman, we've lived with situations similar to that before. I can remember when you couldn't get a loan unless you had at least 15% down payment, and you had to have all those guarantees. It's just that we've been living the high life for a while. Now we're going to go back to a more conservative life.
First, I just want to say on Peter's block, there are all these beautiful homes. Then there's a bunker right in the middle of that's where Peter lives.
That's a joke, Peter. You can laugh.
I digress here. As a corollary to what Rob said, on the demand side, let's look at that. And kind of, in contrast to what Peter said, God, isn't that, different from what a position I take, a surprise. Population is growing by 3 million Americans a year. We're now building 700,000 units of new homes a year, 1.2 million of total new homes a year. It's not keeping up with the growth in population, which means, and don't forget, underlying the job market, et cetera, earnings still pretty decent. Prices might not have to come down that much more because of demographic factors, the growth in population. Peter, that's where your demand comes in. You're totally forgetting about the demand side. I understand the supply.
There's going to be demand. Mike, there's going to be demand, but at substantially lower prices. People cannot afford these crazy prices. David, when you talked about in the past, when you had to put a high down payment, sure, but prices were a lot lower back then. The prices that exist today, these price levels are phony. They only got here because of the fact that you can buy a house with none of your own money and have a teaser rate. These are fantasy prices.
And Nicole,
they're going to go away.
You can't tell me that these houses that were built as spec houses maybe 2 years ago before the fall in housing, and they're empty, and these guys have this price on their back because they put out the money to build a home that somebody's not going to go under soon, and this is going to be a chain reaction.
I mean, there's definitely going to be some fallout from all of this. You just can't have all this inventory sort of laying around. Home builders are going to be hurt. There's no doubt about it.
Already are in some cases.
And they will further. I think, the next 3 to 6 months, we're still going to see a lot of the price.
I'm just wondering if
we have to get rid of that inventory.
What about all those petrodollars? Might we have a lot of buying coming over from Arab sheiks?
Look, that's the interesting thing. We've always had this conversation. How come oil prices not tanking the economy? There's a certain circular flow there. We're seeing it come back again. Abu Dhabi. But listen, there's a flip side to the housing thing. Yes, some people made bad decisions. They bought when prices are too high. Some people are going to benefit from that, right? They're going to get real assets, real property, housing at lower prices. That's a good thing.
Well, and finally, the rumor is, and it's not even a rumor, it's pretty much substantiated, that a lot of Canadians are coming down and buying up all the cheaper properties in Florida. I mean, this is
that's not good for America.
You never saw Canadians in Florida.
Sure, it's good for America.
No,
they're coming here and they're spending money.
Liz, they're buying our assets out from under us. And ultimately what's going to happen is the dollar continues to tank. Foreigners are going to end up buying all this stuff. You think it's a good trade-off? We get their oil and they get our corporations. They get our prime real estate. America, we're selling off our farm to buy milk.
All right, well, gang, another thing, by the way, that's coming down, Rod, is the price of oil. As we speak, it's about 3 minutes from the close. $90.58 it's going down. Is that going to affect all this?
Yes, I mean, oil prices have an impact on the economy, not nearly as significant as you think. I mean, oil has tripled. If I told you 2 years ago that oil was going to go near $100 a barrel, would you have told me that the stock market would have gone up 20% in that same time period?
We borrowed the money to pay for it. That's the problem. We haven't paid for it yet. We borrowed all that money.
Well, the economy is still growing. GDP is probably going to come in close to 5% tomorrow.
That's if you believe the government. If you believe reality, the economy is contracting.
Yeah, of course, but there's also 123 million Americans that are working right now and helping propel this economy.
56 million that are working.
Well, depending on if you want to use the...
You use payroll plus household data, it's total 156 million.
Yeah, and they're still having to borrow money.
More supportive to my point. More supportive to my point. And also, housing prices have increased double, triple in some areas in the last 3, 4, 5 years. A 5% decline, while nobody likes to see it, is part of what happens in an economy that has expansions and contractions.
And you just said it yourself.
We got
prices
Peter.
have tripled.
As much as we'd love to hear more from you, we got to wrap up this segment, but we will be getting back to Peter and Mike and the rest of them. The housing slowdown has been responsible for many jobs in the mortgage industry just disappearing, but most still remain on the job, even if it's a very different environment.
We're joined now by Frank Candy, a motivational speaker who's been busy talking with employees of major lenders about staying focused, along with Peter Schiff from Euro Pacific Capital. Nice to have you both, and let's start with Frank Candy. Frank, I think it's maybe an understatement to say that some of these companies that deal with mortgages and selling homes are just saying stay focused. They're pushing them to keep selling at a great pace, and I'm wondering what kind of incentives they're using and what tricks, dare I say tricks, they're trying to pull over on people to get them to keep buying real estate.
It's not really tricks. Well, first, Liz and David, let me thank you for allowing me to be on your show today and inviting me. I appreciate it. It's not tricks. It has to do with a couple basic things. One, people in the mortgage industry need to be proactive. And a lot of people came into the industry at a time when they just hired them because they had a pulse, and they brought them in because they needed bodies to fill desks and to answer phones and to respond to emails and to fill out forms and applications and get the deals done. They had deals piling up and they just needed to bring people in. And when things slowed down, all of a sudden, they were told, you got to go out and make things happen, and they weren't trained to be proactive. And so today, people need to work on developing and building good quality long-term relationships with people. And that's part of what I talk about in my speeches.
All right, Peter, you're the devil's advocate here. Go ahead and be gentle, okay? But go at him.
Well, first of all, we know that there are way too many people employed in the mortgage industry and the real estate industry, so that's got to change. A lot of the people who are in the mortgage industry or real estate, they're going to have to find some other line of work. But certainly there's still going to be jobs in that industry. It's just going to change very differently. Right now, you've got a tough job. Most people shouldn't be buying homes. They should be renting them. But certainly it's a great time to sell a home if you can find somebody foolish enough to buy it and they can get a mortgage. So that's one thing that you can encourage, people to help people try to get rid of their homes. I used to speak at this conference for the Western Regional Mortgage Bankers Association. I speak there every year. They had an annual convention. They always had a motivational speaker trying to get people motivated into this market. I know it's tough to do, especially when prices are still too high and they've got to come down.
So Frank, how do you motivate somebody? What is your effort? What do you do?
Well, there are a couple things that I certainly mentioned earlier, and I don't agree with Peter in the fact that he's saying if you can find a sucker to buy a house, that's not reality today. There are great deals out there traditionally, and there's always ups and downs in every single market. And this is part of what I tell people. I've lived through 3 of these, and every time when things are down like they are now, people make a lot more money than they do when they're going up.
Yeah, well, the problem is, though,
people need to look for opportunities.
Yeah, the problem
is, there are plenty of opportunities out there. Now, I do agree with Peter on this. There are a lot of people in this industry, and the industries are changing. And again, this is one of my messages. The 7 words of a company in trouble, or a nonprofit organization, or a church, or a Boy Scout group, or a company, a small business, a big business, the 7 words, we've always done it that way. And you'll hear him talking. My daddy did it that way. My daddy's daddy did it that way. Hey, we understand that.
But Frank, what about a specific critique made by Peter that you should be encouraging people to rent at this point until the prices come down further?
Here's the situation. Every market is going to be different. Here in Orlando and in the Florida market, we've got 50,000 people a year moving here. Unemployment is at 3%. That means 97% of the people might be looking, are at least qualified to buy a home.
Yeah, I just got back from Florida. I was talking to a woman down there that just rented a 4-bedroom home. She's paying $1,125 a month to rent a home where similar homes are selling for $600,000 or $700,000. It's still so much cheaper to rent. In the segment we just did, somebody pointed out that real estate prices in some parts of the country have tripled in the last 4 or 5 years, yet they're only down 5%. I mean, if a price can triple, they can collapse by 50%.
That's got to be the last word, gang. Frank Candy, Peter Schiff, thank you so much.
We'll be right back with more in an update.
Thank you, Tracy. We wanted to pull up a Home Depot chart now because, interestingly, it is not the best performing name on the Dow, but it's definitely one of the best performing names. Look at this. Home Depot today is up 4%. It was one of the few that was down yesterday. Of course, it's very closely tied to the housing market, and it dovetails nicely with our next discussion about all these dire predictions for the economy and what our next guest says.
Yeah, we have heard all these dire predictions. In fact, Goldman Sachs came out with a prediction today saying that we are more likely to have a recession, but our next guest says not so.
John McCauley, special economic writer from Dow Jones Newswires, is in the newsroom. John, I know you've watched many a recession go by, and some not happen, some come to pass, but what do you make, especially when you look at a stock like Home Depot today, compared with the Dow, which is up 321 points, about the prospects or possibilities of a recession?
Well, I don't think we're going to have a recession. I think we're going to have a pretty pronounced slowdown. But first of all, we're going to get GDP revised up tomorrow, probably substantially. At Dow Jones, we're looking for a 4.9% number for the third quarter. It could be north of 5%. So it makes a higher cliff to fall off of, but I don't think we're going to completely collapse. I think we're going to see slower growth in the current quarter and slower growth in the first half of the year.
But if we see those revised figures going up, will we see more of what we see today on the Dow? That is, will the market react in an up fashion?
Probably not. It's perverse enough to think, well, gee, if it's that high, it's going to get lower. And in addition, it is kind of well behind us now, the third quarter. I think there's more interest in what's going on currently, but I think that the fact of the matter is that there's still slower growth, but growth.
John, let me play devil's advocate here. Some would say we're already in a housing recession, we're in a dollar recession, and that perhaps we're going to be in a recession to follow at some point. And these are some very smart people. I mean, you've had Alan Greenspan mention it in the past, and people at Goldman are certainly feeling negative about it. But what would really make it happen and make it a reality to have those 2 consecutive quarters of contracting growth?
Well, even that isn't a real definition. It has to be widespread, prolonged, and deep. And I don't think that we have enough out there to make it deep. There are a lot of things that are slowing us down. We've got high gas prices, we've got financial problems, we've got the housing problem, but unfortunately not every sector can be as healthy as some of the other sectors are.
All right, John, if you can stay with us, please. We want to bring in the views of our panel as well.
And we'll start with Mike Norman here. We also have Nicole Ridgway from smartmoney.com. And Rob Stein with Astor Financial, along with Peter Schiff, author of Crash Proof. Mike Norman, I'll let you take first crack at this one. John is saying really no recession in sight. Try and think objectively. I know you're a big bull, but what do you really think about a prospect of a recession?
I think it's very low. I agree with John. Look, even if we say, let's assume we're in a housing recession, contribution from exports alone, and I mentioned this in the other segment, more than offset the what housing took away. In addition, we saw a very good business spending and investment, and consumer spending was up there too. We just got an 8.3 increase Black Friday in the kickoff for the retail holiday shopping season, much stronger than anyone expected. Liz, I just do not see it out there. If we come down, and John's right, we're going to see a 1% revision to the third quarter, bringing us up to 5% in the third quarter. Incredible growth. Even if we see a downturn, you got to average those numbers. We're still running around 2.5%, which is decent.
All right, so Peter, you agree with both of our guests, right?
Well, I agree with none of them. I mean, first of all, I agree one thing: a recession isn't coming. We're already in a recession.
By what measure?
The economy is already contracting. You're looking at these government numbers. We're measuring our economy in shrinking dollars. The dollar is losing value. All these measures that purport to show economic growth, they're phony. You've got to look at reality. And the recession is going to get a lot worse. It's just beginning. It's going to be extremely pronounced and widespread and long-lasting. And in addition to a severe recession, consumer prices are going to head substantially higher. And so will interest rates. And that's just going to exacerbate this recession.
Rob,
we haven't had anything like this in our lifetime.
Okay, Rob, you know, my mother asked me an interesting question. She said, what would a recession mean to me? How would I feel it? Just so for people watching who've never experienced one before, what does it feel like and how does it affect an individual person?
You know, Liz, that's a great question because I think that is what a recession is.
All right,
when
Mom.
the average consumer, the average person feels that the economy is contracting, they feel that their job security is at risk, that they feel their financial situation might not be able to sustain their lifestyle. That's really what a recession is, and it boils down to jobs and job growth. There's never been a recession that hasn't come from lower employment data. We haven't had negative job growth on a month-to-month or quarter-to-quarter basis in a while yet. Yeah. And I can't see us heading into a recession when we're adding 100,000 plus jobs each month.
Hold on a second, Peter. Nicole, let me just think one positive thing of what you hear coming out of Peter, which is that it makes it much more difficult for politicians to raise taxes. It's one thing you don't want to do if we're heading into a recession.
That's true. Yeah, you don't want to raise taxes. I'm
looking for a silver cloud in Peter Schiff.
The other guest.
Hold on, Peter. Go ahead, Nicole.
I mean, obviously, you know, a lot of eyes are on what the consumer is feeling and how safe they're feeling and what they want to spend and what they want to save. And taxes do play a role in that. You know, if they are paying more in taxes, they're going to feel like they have less money to spend. And we don't want them to feel that way if we want the economy to continue to grow.
All right. Let's take another check of the markets as we have to go to a break. Peter, we'll get back to you, I promise.
Look at this. This is amazing. Listen, are legal problems for Countrywide being overblown because some want to scapegoat that particular company for the entire mortgage mess? This is a question that's important to ask.
Well, let's ask our panel, including this time Jim Petrakakis from U.S. News and World Report. Let's start with you, Jim. What do you think? Is this something that's going to spread, or is it just specific to Countrywide? Countrywide, by the way, seems to be the only company that we've noticed that's really being hit today.
Well, you know, first let me say that it's really amazing that here's a country that was, allegedly sticking it to its customers and still losing money. That's quite a duo, and it's quite a trick to pull off. But listen, if this does spread to other companies, and right now, I mean, obviously, as you said, it's the flailing bird, Liz, and they're all going to focus on Countrywide. I think what you're liable to see, at least out of Washington D.C., where I'm at, is a Sarbanes-Oxley for the housing industry, for the credit industry. I think you're going to see a huge legislative reaction in the wake of all these scandals. And my fears really goes beyond what's going to happen to this company, but what's going to happen to all these lending practices. It might be more difficult in the future to get a loan because there'll be such a regulatory layer placed on all this stuff that it's actually going to hurt the housing and lending industry going forward over the long term.
Mike, is it fair to make Countrywide the Enron of the housing industry? Because, of course, Sarbanes-Oxley came about because of that.
And we saw the after effects with Sarbanes-Oxley. It got a lot more difficult for many companies to, conform to, having to do their filings, etc. You said it. I mean, the flailing bird. And Jim is right, too. I think, actually, Peter Schiff's prediction could come true about a contraction, a serious contraction in credit to consumers if we see this sort of regulatory environment come down in a very onerous way. And it could, because you have the finger pointing going on now, right? They start with Countrywide. If there is wrongdoing found there, or if there's a sense that there was wrongdoing or unscrupulous lending practices, it's going to spread. You know it. You had Schumer piping into the mix, Senator Schumer piping into it recently. So I think there's a danger here that we get into a very heavy regulatory environment, and that will impact, more than anything else, the implosion in the housing market. That'll impact.
Peter, is it possible that politicians will overshoot on this?
Well, politicians always make things worse. But we got to look to the reason why Countrywide was able to do what it did. The real cause of these problems was the Federal Reserve. It was Alan Greenspan that created the monetary policy that made this real estate bubble possible, that facilitated all these crazy lending. And I was criticizing this at the time he was doing it. So this was a predictable result of irresponsible monetary policy. And what the Fed is doing right now by cutting interest rates, it's just as irresponsible, and they are creating a lot more damage to this economy.
You're right, Peter. In fact, a couple of years ago, you were saying that exact thing, which leads me, Nicole, to ask you, got to figure Alan Greenspan is kicking himself and saying, I should, because in his heart, he was a little concerned about the housing situation, but he didn't take it that seriously, or seriously enough, perhaps?
I mean, you could definitely argue that, and I think that a lot of people have, that Greenspan did have that knowledge beforehand, and he could have done something a little more proactive to actually prevent this whole mess from happening.
Come on, just blame him, will
you? No, it's not just preventing it. He created it. He caused it.
No, Peter, look, we're forgetting about one thing. Remember Alan Greenspan spoke about the conundrum, which basically said throughout the world there was this huge glut of savings, which was flowing throughout financial markets. The Fed, in fact, was trying to raise interest rates. Long-term rates stay down because of the fact that of these global saving flows. They came into our economy. Money was freely available. Credit was demanded. Banks provided the credit. It's a function of expanding wealth, free market, expanding wealth in the global economy. It is not an evil thing or a sinister thing. It's the way it is.
Quickly, Peter, quickly.
Alan Greenspan is the one that lowered interest rates down to 1% in the first place and left
to prevent a deflationary spiral. Come on.
He should have allowed that recession to run its course. It's now going to be a lot worse because of what he did.
All right,
we should have bitten the bullet when we had a chance.
We got to leave it at that. Woulda, shoulda, coulda. The question that... Just a couple of minutes away from the closing bell, and markets are still surging.
Yeah, look at this. Dow Jones Industrials now up about 348 points, and that's not even the highs of the session. 13,307 is where we are right now. The high today has been 13,325. So we're a little bit below that, but not by much at all, which leads to the question, is this the beginning of the recovery from the credit crisis, or just one of those blips on the volatility radar? Let's check in with our Fox panel, and once again, it's the usual suspects. And Peter, come on, it's up 342 points. Isn't this the start of something new?
No,
to quote High School Musical, by the way.
No,
Nice.
bull markets climb a wall of worry. Well, bear markets slide a slope of hope. And these big rallies, they're designed to give false hope to people. It's like slowly boiling a frog. You got to sell into this rally. Don't read anything into it. The problems are just beginning. This is a bear market rally, nothing more. And the problems for the economy are only going to get worse.
Well, Mike, you put your money where your mouth is. You go out and buy stuff. Would you be selling with this rally or
buying? By the way, as if there hasn't been worry out there, I think the wall of worry is pretty high. Look, again, I was talking to Wilbur Ross, one of the most astute value investors yesterday. He's buying financials. He's moving in here now. I think that speaks for itself. I think there's a lot of important things going on here. You look at a 10% decline in crude oil prices. You look at some very, Peter follows currencies, some very interesting so-called commodity currencies. The Canadian dollar down 10% in the last month against the U.S. dollar. The Australian dollar, another interesting commodity currency, down. We've actually seen, as Peter has been forecasting, some liquidation by China and Japan of treasuries. But guess what? Our interest rates have come down. They haven't gone up. A lot of positive things happening here. I think the market looks good.
Jim Petrakakis, what do you think?
Well, listen, if you're a long-term investor and a long-term believer in America, you know what? These kind of declines, these 10% corrections can be scary, but you know what? That's the time to buy. That's not a dollar cost average. Buy all the way down. Listen, if it's apocalypse now time, like Peter said, and we have a recession on the way, then you know what? Then the damage is maybe only a half over, if that. But I don't think so. I think the job market remains resilient. I think the income gains remain good. We just saw that this last weekend. So I think there's a lot of reason to be bullish and to think that going into 2008, that maybe the worst for the market, for the economy, is happening right now, and then we accelerate going into next year.
And Nicole, Mike makes a very important point. If the smart money is going in and buying the financials now, isn't that really the test of whether this market has bought out the financials?
Yes, I think the financials are really where you want to keep an eye on. I think Wells Fargo was upgraded today based on the fact that the analysts believed that it had been beaten down so far. This is a buying opportunity for certain stocks. And, of course, it's for the long-term investor, as Jim said.
And it came out with a $1.5 billion write-down, by the way.
Mike, give me something else that's a buying opportunity other than the financials that may scare away some people. What else out there that we haven't talked about?
Well, I happen to think the home builders, for example, that look terrible. And I hear
but
Peter
that's scary, too. You brought
that's
up Wilbur Ross. How about coal?
Wilbur Ross. No, I would not buy gold. Look.
Coal, I said.
Oh, coal?
That's what he likes.
He likes coal. Coal had a good run. I mean, I don't follow it that closely. I mean, coal had a good run. I couldn't give you a very insightful opinion on coal right now. I had some coal stocks.
Where in your stocking?
They're they pollute the atmosphere. I don't know.
Just keep buying those home builders and the financials. I'll keep buying gold and you mentioned those commodity currencies. The New Zealand dollar is up 2.5% today alone. That's as much as the Dow. And sure, the Canadian dollar pulled back 10%. It went to $1.10.
But Peter, how do people invest in that? Tell them what way they can dip their toe into something that seems as sort of exotic as a New Zealand
That's a very interesting
collar.
Question. I'm glad you asked that question. But yeah, because that's what I do. That's what I've been doing for my clients for almost 10 years.
How?
What you do is you don't invest in the U.S. market. You go and invest around the world. You buy stocks in countries that have appreciating currency, so you get the wind at your back, not in your face. You buy stocks with low PEs and high dividend yields. And yes, you buy and hold for the long term. You buy in Singapore. You buy in Norway and Sweden and Switzerland and Hong Kong and New Zealand and Australia and Canada. You avoid the U.S. market, and you invest in good quality companies around the world. And if you want to speculate, go into the emerging markets, and buy commodities. And yes, buy gold and other things that are in bull markets.
Jim Petrakakis, we got to emphasize here, this is not for the faint of heart. This is very risky trading. I think if people hold on a second, Peter. We have to put out a proviso here, because when you're trading with the likes of George Soros and people that trade currency all the time, you're trading with some pretty fancy traders. Jim?
That's absolutely right. You know, I'll tell you, I agree with Peter that, you know, people need to have more foreign exposure. But the best way to do it, I say, for a lot of people, if you don't want to make this a part-time job to do some stock picking, don't forget not only just mutual funds, but these exchange-traded funds, ETFs, which not only can you invest very easily in foreign markets,
that spreads
but you can
the
even
risk. And I think even Peter would not disagree with that, would you, Peter?
Well, no, I mean, I prefer to pick the stocks myself. But, you know, the point is, David, the risks are here. The risky investments are in America. My clients want to avoid risk. They want to get out of harm's way. We're investing abroad to protect our wealth and preserve our purchasing power. This is not risky.
Here's what's wrong with that.
You know, some of the greatest value, you talk about good companies that present value. They're here in the United States. They're multinational companies. They produce more than 50% of their income comes from abroad. It's a way to diversify yourself. You know, those are undervalued plays. And just quickly on gold. Gold, even at $800 an ounce, where it is today, is still far below in constant dollar terms where it was in 1980. It should be around $1,600 an ounce.
That's
you
why
haven't
I'm
made
still
any
buying
money. If you bought gold in 1980, you're still hoping to get your money back. It's been a terrible, terrible investment.
That's right.
That's not true for stocks.
Mike, I didn't start buying it until 1999 when it was under $300 an ounce. I made a ton of money. And I'm making money every day.
I hope you're nimble enough to get out when it starts to go down.
But guess what? You could have made a lot more money if you bought Google stock, Peter.
Well, look, I could have made even more if I bought, you know, internet stocks in China.
Or Apple, something a little more substantial than China.
But we'll see. A lot of people who hold Google and Apple haven't sold yet. We'll see in a few years how much money they made on those stocks.
Well, while we were talking, the Dow pulled back just slightly.
They were listening to Peter.
Yeah, well, I'll tell you something. Right now, we're...
The market keeps rising, and as we left you, it was under 300. Now it's over 300. It looks to be settling at around that point. It is a great day on Wall Street.
Although a lot can happen in 7 minutes, you just never know. Dow Jones Industrials at 13,263 on a day where we had oil down more than $3. That powered the object, you know, the happiness about the buoyancy sort of the markets here. But also Donald Cohn of the Chicago Fed talking about how there would probably be, or the potential to be, nimble. And people read that as yet another rate cut coming up December 11th.
Kind of those, it's a bad story, and that's why the market thinks it's a good story, because they'll cut rates and things will be better for the market. But the bottom line is there is a lot of good news behind these numbers as well, including perhaps the notion that we've turned the corner on the financial crisis. And let's throw that back to the panel. Now, is it conceivable, Mike Norman, that with all of the various machinations, all of the different kind of financial instruments tied into mortgages, that we are close to the end, or is this thing still got a long way to go?
First, I want to say a few things about coal. No.
Because you know so much.
Now I know so much. Thanks to you,
All it took was the commercial break. He did research quickly.
Look, what you're talking about, there's a flip side to everything, okay? We know who the losers are. Some of the banks, the creditors, the lenders, people who bought homes, they paid too much money. There's a flip side to it. During that credit bubble expansion, the economy was very strong. Businesses made a lot of money. Corporate cash on balance sheets is enormous. The second aspect of that flip side is that a lot of people out there in America, potential home buyers, people who want to accumulate assets on the cheap, they're going to have their opportunity. Listen, real property, real estate, housing, it's not like we had a bubble in tulips here, okay? These are valid assets, and I think in the end it's going to be fine.
Tracy, I know you're watching some of these names. I love the fact that General Motors is up 4 1/3%. This has been a dog for so many days, and here we have even General Motors not just moving higher, but having a real rally.
Well, all of them. That's not, even the financials. They were hammered. I mean, well, we have to keep the financials in perspective. You know, by the end of trading yesterday, year to date, the financials were down almost 22%. The sector as a whole was up 5% today. So, I mean, it's gotten some back, but clearly not all of it. You know, we have to be careful when your day goes from frightening on Monday to fabulous 2 days later. So we, again, have to keep all this in perspective. And that basically what happened today was there was just less bad news. We had a little bit of good news from the Fed, saying that, you know, maybe there will be another cut. But I think we, again, need to be careful. We need to put this in perspective. The volume definitely picked up. It's a lot of, it's all up volume, though, so it's all buying. You know, Liz, as you said, this last 10 minutes of the day are the best part down here. It's like a basketball game, right? Everything happens in the last 10 minutes. Thankfully, we're holding on thus far. But I think we need to be careful going forward. I don't know if this is like our takeoff point.
Has she been dating Peter Schiff or something like that? She sounds negative.
No,
it's good
like it's like the Lakers versus the Celtics back in the 80s. Yes, right?
Yes, yes.
Last few minutes here.
Well, I like Red Auerbach, so I prefer when the Celtics were winning. But Peter Schiff, give us a little bit of caution here. What do you think is going to happen next? What's the next shoe to drop?
Oh, there's so many shoes. It's a centipede. You know, there's no way to know which one is coming next. You know, on the days when they have short covering, there's a lot of short covering coming on today. You know, the worst stocks go up the most because that's where the shorts are covering, and so that's why you're seeing strength in the home builders and the financials. You know, the gold stocks are having a good day today too, Mike. I mean, you know, I've got a lot of gold stocks and mining stocks and oil stocks that have actually outperformed Google. You need to take a look at them.
All right, we got to go. We're up 331 points, closing bell just around the corner.
We gave him the last word, though, but we've got a lot of good news to continue to report on. Keep it here.